Good. Okay, Chapter 8, Managing Working Capital. When you hear that word working capital, what comes to mind?
How much money you have to play with?
How much money you have to invest?
Your cash,
Just today, how much money I have.
assets,
What kind of assets?
things that you can turn into money or
Liquid,
liquidability.
there you go. Liquid. Short-term assets, the sum of short-term assets. In accounting, when we talk about current assets, what time period am I referring to?
Less than a year.
1 year or less. When you hear the word current, liabilities, it's an obligation that's going to come due 1 year or less. So when you hear the word current, 1 year. You'll also think of, if it's within 1 year, it's how quickly you could convert it. Well, you introduce that term liquidity, how quickly it can be converted to cash. So you're going to think of, in current assets, you would think of cash, accounts receivable, items that you've already provided the services for and you have billed out. And we know there's a delay in getting paid, but hopefully you get paid within 1 year. And then any type of short-term investment, if you have investable assets that were going to come due within 1 year, would be a. All right, so I said that term of liquidity, and remember that will always be the measurement how quickly in that 1 year it can be converted. All right, so 2 other current assets that I got to mention. Inventories. That would be a big one because you expect to turn those inventories over to generate cash. The one that's often overlooked, any prepaid expense. Give me an example of a prepaid expense.
Insurance.
Insurance. Money paid in one accounting period. You're paying for it, but you are entitled to the benefit from it in the future. A prepaid expense. Your auto insurance. I'll relate it to you personally. Your auto insurance. You get that bill and you pay it. What time period are you paying for? Something in the future. That's a current asset to you because you're entitled to the use of that benefit for 1 year. Net working capital. The difference between current assets and current liabilities. So this is your current liabilities subtracted from current assets. Why is that of importance? Current liabilities subtracted from current assets. That's an indicator of your debt paying capability. So particularly think of your shareholders, think of your stakeholders. Anyone that was going to loan you money, that's going to be something that they look at. How likely are you to be able to pay your debt? If there was some expected shortfall or drop in your activity, how quickly would you be able, how much liquidity do you have on hand? And hopefully you have more than you have expected to go out in 1 year. Give me some examples of current liabilities. We're going to subtract them out. What are we going to subtract out?
Wages payable.
Wages.
Yeah.
Okay, now think about that. You go and you work. You work your 40 hours. Let's keep it simple. You work your 40 hours. Your employers pay you for time you've already worked. That's a current liability, though, to them.
What about taxes and property taxes?
Accounts
If they are
payable.
going to be due within 1 year,
It all falls under accounts
I mean,
payable.
I don't know because you're paying for previous. I don't know how that really factors in.
the liability, if it's due, if it's expected to be paid out in 1 year or less, we're gonna call it a current liability.
Okay, so taxes then, or property.
So that wages payable is what I just used, accounts payable. If you have bought something on credit and you've got to pay for it within 1 year, which you probably will, you know, that is a current liability. Taxes payable, I'll give you a good idea. If you ever hear the word receivable too, associate that with the asset side. You hear the word payable, associate that with the liability side. All right, so working capital is the catalyst that makes assets productive. All right, so we want to have sufficient amounts of working capital. We need to be able to pay employees. We need to be able to pay our vendors. We can't pay them, we're probably not going to have good vendor relationships. Okay, we'll probably, if we can't pay our employees, we're probably not going to have any employees. All right. All right, it also demonstrates, again, to anybody who in the credit markets that you are credit worthy, and again, that you are able. What are sources of working capital?
Equity, net income, borrowed money from investors.
Equity. What is equity if we receive it?
It's just money that comes in. I mean, you can say from investors, you can say really from, well,
Just stop right there.
yeah, I'll stop there, yeah, because
Money that comes in through investors. Net income.
Sure.
money after all expenditures have been paid and everything.
Money left over after all expenses have been paid. Borrowed money. Okay, again, think of us as going out and tapping credit markets. All of your facilities. I'm going to say, especially these on the Kentucky side of the river, you have benefited through credit markets. Bonds have been issued and sold to investors for you to expand. And sell of non-current assets. Okay, that is if you had a facility that you were, or a piece of working capital that you were no longer using, you could dispose of it and sell it. Right now, you could sell it to you could sell it to another part of the country or even the world. You could sell it to a less complicated organization. All right, now speaking of these credit markets through bond issues. All right, so that is one source that you get. Does everybody know how a bond works? All right, so you get together and you decide that you have the need to raise capital. One way that you can do that is go to a governmental organization. You would partner with the city of Louisville or the state of Kentucky. Okay, what would happen? You could even partner with the state. What's happening is you would go in, you would issue a bond. It means they are going to give you, they could either come in and back it, they could reduce the taxes that would be for somebody who bought it, the interest they received, they could reduce the taxes that would be due on that. They would allow you to package this instrument and you would sell it to an investor. It would be sold in increments of $1,000. And it's going to have a fixed maturity date. So we put in 1,000, and this might go out 20 years. Now, what's going to happen is each year, there's going to be what's called a coupon attached to that. And that is the amount of interest that you must pay for borrowing that money. And let's just say it was 5%. So an investor would buy that, would give you $1,000 and receive that bond, and you are entitled every year to make this coupon payment to them. And then at the end of 20 years or at maturity, you must return that $1,000 back to them. So you're only borrowing the money for that period of time. And then you must pay that money back.
But along the way, I'm paying them 5% interest at certain times,
You're paying them certain times.
paying back to the person. Okay.
And I would tell you, in today's marketplace, in today's historically low interest rate environment, you are going to probably pay something more of 1 to 2%.
Okay.
A lot of facilities are taking advantage of this right now in the current market. You know, again, our government is even issuing our government is paying historic lows on U.S.-backed government bonds. So again, we see more and more of this going through. All right, nonprofit organizations can get capital through, again, to other tax exempt organizations. So the state might just give them money, or the city might just give them money. You could even get that through some other type of religious or service-based organization. For profit. How do you get your money?
Make it ourselves.
All right, now here's a little joke from the finance person. We never make money. You know why? Our government says it's illegal to make money. We earn money. We never make it.
But I'm
I always want to aggravate a finance person and economist, say you make money, call a zero and O.
Oh.
Call a decimal point, just a dot.
Don,
Yeah.
speaking of that, somebody was trying to pass a counterfeit $5 bill at Thornton's in Clarksville, a $5 bill. I guess they figured they wouldn't check it, because usually you check 20s and up. But, yeah, so there's
It used to be a
counterfeit
$20 bill was the most counterfeited bill. And now that denomination has fallen, because if you look at if you even look at a 20,
There's a ceiling.
you see the seal and you see all of the ink. I don't have one.
Make it rain.
Not that $1,000.
Hey,
We're gonna start teaching.
I think we should go out now.
I know.
I'm hungry.
so no, but now you've seen it fall down to $5.
Yeah.
Right now it's becoming the most highly confiscated bill, again, because of there's less protection measures in there. So that would be why.
Dude, I mean, you need to go.
But anyway, you for-profit organizations, you receive your capital by issuing stock. Now, when you issue stock, what you are doing is actually issuing part of yourself. So that means you are selling, or you are transferring ownership of yourself to investors through the issuance of stock. That stock could either be private, where it's not traded on a exchange, or most likely in your case it's public, where it is traded and readily available to other investors. But again, that's how you get your capital. All right, so we could say that when a healthcare organization has the need to raise capital either for long-term planning expenditures or even short-term disruptions in the business cycle, they're going to tap into either the credit market, they're going to tap into the equity markets. We'll use those two examples. Okay, they could issue some type of trade credit to a lesser degree. All right, let's look at page 202 at sources of a working capital. All right, and this is going to be something like what goes on during one small cycle. on day one, you see a patient. But now, employees work that day. So you already have created that debt before you might have even seen. You created that liability before you even saw that patient. Or at the same time that you saw that patient, you've definitely not been paid. You've not even billed them yet. All right, accounts payable. You used supplies. You used hospital resources. In this example, day 3, the patient is billed. All right, day 14, you paid your employees. You're getting paid every 2 weeks. And day 63, patient pays. The only thing that's probably different in that, you chuckle at being billed on day 3. Do you bill earlier?
No, we don't
No,
bill on
way
Monday.
later.
Much later.
Way later.
Okay.
Depends on.
You have to wait on the physician to,
So think
Document it.
about
At
that.
least, yeah. Yeah, they have to do it within 30 days.
And I would say that right there is a finance person's nightmare.
Mhm.
That's what's keeping your controller.
Can't
When
drop
you think
bills.
of efficiencies and ways that you can speed up and increase your payment, this is one area of concern. You're racking up all these liabilities up for 63 days before you get paid. So you're going to be in arrears for over 2 months before you are paid. All right, look at the next page. Sources of working capital. All right, I'm going to say that usually on the short term, we see temporary working capital or increased workloads. This is going to say that it's typically financed with debt, a permanent working capital, financed with equity. And the reason I would say finance with equity, remember, for you for-profits, when you do that, when you issue stock, you're issuing part of yourself. You're transferring ownership. Now, I would tell you, in today's market, I don't want to say everybody's loading up on the debt cycle, but I'm seeing this probably getting the first look for the low interest rate environment. Number 2, as an expense, when you're paying this interest, this is a tax-deductible expense. It's interest expense that you get to deduct. Now, for you in the nonprofit status, that does not come of a big concern. For you for-profit folks, you're paying taxes on that net income. So in a way of managing that tax liability, you can deduct that. When you issue stock, there's no tax deduction on that. All right, let's look at an example of an effective interest rate. Page 204. ABC Nursing Home borrows $100,000 for 6 months at 3% annual interest. So here's your example. How much interest will ABC pay for the loan? Don't just think you're going to multiply rate times interest. We're going to apply a formula of rate times interest times time. So in this example, we're only using it for 6 months. So therefore, you must take account for that 6 months. Just remember that formula. Rate times interest times time. All right, so we see that the effective interest rate is going to be $1,500. All right, a trade credit. Over on page 205, ABC makes a $100 purchase with a 2/10 net 30 provision. What's the effective interest rate if the clinic pays on the 11th day? First off, what does that mean? Somebody explain 2/10 N/30.
You pay within 10 days, you get 2% off. Now, what was the second one that you said?
N/30.
And then at 30 days is the full amount?
She's cheating because I lectured on that last night. But that tells me she paid attention last
I
night.
answered it last
You
night.
get a 2% discount if paid for within 10 days. But if you don't take advantage of the discount, the full payment is due within 30 days. So what's the effective interest rate? First step, calculate the annual interest paid. And we see that the annual interest, by taking advantage of that discount, is going to be $730. On day 11, what's in step 2?
$98. The $2.
Amount borrowed is $98. It's going to take advantage of 2%. You'll calculate the annual interest paid, divide that by the amount borrowed. You'll come up with $7,449. Okay, note what I just gave you. The book is rounding. I carried out to 3 decimal places. I have 7.449. They have 7.45. Now because you're asking what is the effective interest rate, when we communicate an interest rate, be sure that you take that final step and convert that to percentage form. Everybody know how to do that? Slide that decimal over 2 places. Now on day 30, you got to figure that at that point the full amount's coming due. All right, I'm going to give you over on page 210. We're going to end right here before we ask some questions. Do some more ratios. Again, that current ratio, current assets divided by current liabilities. What's that tell me? Worth, really?
How you're going to meet your financial obligations.
How I could meet my claims paying ability. What's the likelihood that I can meet those obligations? All right, so days of cash on hand from short-term sources. I don't know one organization that will not be able to quote how much days of cash that they have on
I
hand.
do it every time at one of my meetings to the doctors. Cash
They
on
want to
hand.
know, if we're not taking any revenue right now, how many days can we meet our obligations? Now, not only, the goal is not to maximize those days. Remember, if you are really charged with maximizing profit, you probably don't want to be sitting on a lot of cash. You want to be pushing that cash into revenue generating activities. So again, if you are looking at days of cash, yes, your business plan, depending on what your budgeting plans are, you're going to want to have enough that you can meet any unexpected disruption. But at the same time, the goal is not to maximize how many days you can operate without getting paid. Okay, so you want to look at it, days on hand from short-term sources and then days of cash on hand from all sources. Okay, the difference here, short-term sources is probably not going to require you to go and dispose of any asset or take more concrete moves. You know, short-term investments are readily converted to cash anyway. So again, you want to look at how much is within arm's reach. Now, it's easy to write a check and it's easy to you're getting paid within a couple of months. But again, if you are disposing of long-term assets, remember that's going to take time. So yes, it's an asset, but it is not very liquid. All right, and average payment period. This is the last one I want to look at. Current liabilities divided by total expenses minus depreciation expense divided by 365 days in the year. All right, how quickly are we getting paid? And I'm sure that comes up in a lot of meetings. But remember, we're racking up that debt. We're racking up that debt, we're racking up that we're racking up those liabilities, we'll say. And again, not getting paid. So we want to pay attention to how quickly we're getting cash in the door to cover those obligations. At all other time, we're operating at a loss. All right, somebody define the terms cash, short-term securities, accounts receivable, inventories, and prepaid expenses.
And one at a time. Cash,
I'm going to ask you to just summarize them all into what category?
Working capital.
Money on hand.
Assets, equity.
Assets. What kind of assets?
Current assets.
Current assets. Cash, we mean cash on hand. Short-term inventories, those that have maturities of less than 1 year. Accounts receivable, money expected to be received within 1 year. Inventories, the value of your supplies on hand, you expect to convert that to cash. Prepaid expenses, money paid for an expense in which you are entitled to a future benefit. What are the differences in sources of capital between nonprofit and for-profit organizations? Let's hear from our nonprofit side.
Bonds.
Bonds, most likely going to tap the credit market. You for-profit,
Stocks.
stock, going to participate in some type of equity transfer in the form of selling stock. All right, what's the main objective of managing cash flow?
Maximizing your intake and minimizing the time paying your expenses.
Correct. How quickly are you managing the cash on hand? One thing I just realized that I overlooked is how to calculate future value. Y'all see that?
we have to do that with a lot of our larger equipment. It's hard to do.
All right, look on page 207. Two calculations that I want to show you are present value and future value. Present value, the current value of an investment. Future value, the future value of an investment, taking into account factors such as interest rate, time, and the frequency of compounding. All right, here's an example. I ask people all the time, older clients. Think about, even in this room right here, I don't know if we're old enough yet, but I like asking people to think about the value that the first home that they ever bought, if they can come up with a value for that home. And then to compare that with the value of the last car that they bought. All right, so what I'm going to say by this, best example, a postage stamp. What's the lowest price that you remember paying for gasoline? All right, so the future value, we understand that everything is getting more and more expensive. So that's going to introduce us to a concept called time value of money. Okay, but the future value is if I needed, we understand that $1 today is not worth, it does not contain the same amount of purchasing power as $1 in the future. So if I need $1 in the future, what must I start with today? Meaning, what would I have to invest today in order to have a future value? You'll see in the center of page 207 that formula is future value is equal to the present value multiplied by 1 plus the interest rate raised to the nth power. That nth power is your compounding factor. So what's going to happen is this is going to grow by the amount of interest that is received and how many times that interest is compounded. All right? Depending on your calculators that you might have right now, if you have a financial calculator, there's going to be a present future value and a present value button on there for you, but here's what we're trying to do. The present value, the current value of an investment. So the current value of an investment. So look at the bottom of page 207. ABC wants to invest $100,000. What's the future value compounded annually at 7% for 5 years? How are we going to solve for this? So what's the present value?
100,000.
100,000. That's how much I presently have. So 100,000. Now I want you to look at this formula up here. Future value equals the present value 1 plus the interest rate raised to the nth power. So my present value is what?
100,000.
What's my interest rate?
7%.
And then how many times am I going to receive that?
Annually should be 5,
For
right?
5 years. And that calculation tells us it's $140,255. Now, what if I'm going to compound it semi-annually for 5 years?
And would that make your,
Be the nth power.
Yeah.
As long as you're not talking about APR at this point.
Don't confuse yourself. We're not saying APR.
If you get it twice a
I'm
year.
compounding it semi now.
It's gonna be 6 hours.
So how many times am I going to be paid?
10.
10.
So 10, still keeping it 7%. So we can see what is really going to drive this factor up is time and then the compounding. So your compounding factor plays an important role in determining future value. I like to say as a retirement planning consultant, I use this all the time. I used to get asked all the time, what did it take to be a millionaire? Start making money. $1 million right now. Guarantee you, right?
At least.
I guarantee you right now. All right. That's all I have. Y'all have any questions?
No, sir.